Fixed income plays an important role in a portfolio, but understanding the two main vehicles for bond investments and the differences between them can help optimize portfolio construction for the long run. The two main ways individual investors invest their fixed income allocations are through individual bond securities and bond funds, with investors increasingly turning to exchange traded funds, or ETFs, over mutual funds. Each have their pros and cons to determine if there's a right fit for a portfolio. Individual bonds are the best choice for capital preservation. While prices of fixed coupon bonds can and will fluctuate based on market conditions, as they reach maturity, the price moves toward par value, or $1,000 per bond, assuming the risk of default remains low. Bond funds do not have a maturity date, so their prices can fluctuate even more so, without ever being pulled to a definitive par value. So the price of a long-term bond fund can actually stay depressed far longer than the price of a bond that has a maturity date in 15 years. Individual fixed coupon bonds also offer predictable income. These securities have defined interest payments, usually on a semi-annual basis, for the entirety of the bond's life. Funds don't have the same predictability. Distributions are generally offered monthly, but at fluctuating levels depending on the underlying securities, the fund structure, and prevailing interest rates. For a smaller investor, though, bond ETFs can offer diversification and liquidity for a smaller investment. To achieve a properly diversified bond portfolio, one would need to purchase many different bonds from many types of issuers, like sovereign nations, corporations, or governmental agencies. With funds, you can achieve that diversification with investments in just a few funds, or potentially a single fund, which usually requires a smaller investment than buying lots of individual bonds. Funds are also much more liquid, or easier to trade, than individual bonds. ETFs trade on an exchange like a stock, with potentially many buyers and sellers actively participating. Individual bonds, on the other hand, are generally held by investors until maturity, so if you wanted to sell a bond before then, you may be required to sell at a steep discount to the market price. Determining the right fixed income securities for your portfolio can seem like a daunting task, but knowing your individual circumstances and preferences can make choosing the proper investment vehicles much simpler.